Hello, and welcome back to Explain the Charts, your channel for detailed market analysis. Today is October 2nd, 2025, and we're diving deep into the NZDUSD pair, which has been on a roller coaster ride after a massive sell-off at the end of September. First, let's cover the fundamental news driving the market, because there is a lot happening right now. The biggest story is the ongoing US government shutdown, which is creating significant uncertainty and putting broad pressure on the US dollar. This dollar weakness is a key reason we've seen a bit of a recovery in pairs like NZDUSD and EURUSD. However, this is clashing with strong underlying US economic data, particularly in the labor market, which just a week ago had markets expecting a more hawkish Federal Reserve. The Fed had previously cut rates, but persistent labor market strength could postpone future cuts, creating a very confusing picture for traders. This week is packed with crucial U.S. employment figures, including the ADP report today and the big NFP report on Friday, which the Fed will be watching closely. On the other side of the pair, the New Zealand dollar is fundamentally weak. Recent New Zealand GDP data came in far below expectations, triggering that aggressive sell-off we saw. The Reserve Bank of New Zealand is also sounding very dovish, with the market now pricing in a 35% chance of a large 50 basis point rate cut at their next meeting. This stark divergence between a dovish RBNZ and a potentially hawkish Fed is the dominant long-term theme for this pair. So, we have short-term US dollar weakness from the shutdown versus long-term fundamental strength for the dollar and weakness for the Kiwi. Now, let's see how this all translates to the charts. Looking at the daily chart, we can see the broader context. After peaking up around the 0.6350 level in late September, the price fell off a cliff. This massive drop of several hundred pips broke clean through the key support zone around 0.5850. That break was significant and was directly correlated with that shockingly weak New Zealand GDP data and strong US jobs numbers. The price found a bottom around the 0.5750 to 0.5760 area before starting the current bounce. This bounce we're seeing now began right as news of the US government shutdown started to dominate headlines, weakening the dollar and providing relief for the Kiwi. Now, that former support level at 0.5850 is the most critical level to watch. In technical analysis, old support often becomes new resistance, and that's the textbook scenario here. Sellers who missed the initial drop will likely be watching this 0.5850 zone very closely for an opportunity to enter short positions. A strong rejection from this level would be a very bearish signal, suggesting the downtrend is ready to resume. On the other hand, if buyers can push the price decisively back above 0.5850, it would invalidate that bearish signal and could extend this corrective pullback towards the next resistance area near 0.5950. The immediate support is, of course, the recent swing low around 0.5750. Let's switch to the 1-hour chart to analyze this current bounce in more detail. Here we can see the structure of the recovery from the lows. There appears to be a minor upward trend line that has been supporting the price during this pullback over the last few days. As long as the price stays above this trend line, short-term bulls have a case to push higher towards that big 0.5850 resistance level we identified on the daily chart. This is the battleground for the short term. Bears will be looking for a convincing break below this hourly trend line. A break would signal that the corrective bounce is over and that sellers are taking back control, likely targeting a retest of the 0.5750 lows and potentially even lower. FexStreet's analysis supports this cautious view, noting that even with the bounce, momentum indicators on higher time frames remain bearish. Zooming in even further to the 15-minute chart, we can see the intraday price action is choppy as it consolidates near the 0.5820 level. The market seems to be waiting for the next catalyst, which will likely be the US ADP data later today or headlines about the government shutdown. Intraday traders are battling around this minor consolidation, looking for a breakout in either direction to confirm the next short-term move. So let's go back to the daily chart and summarize what we're looking at. The primary trend is clearly bearish, driven by a strong fundamental divergence between the RBNZ and the Fed. However, the short-term picture is clouded by the US government shutdown, which is causing temporary US dollar weakness. The key resistance to watch is the 0.5850 zone. This is the line in the sand for bears. The key support to watch is the recent low around 0.5750. Let's talk about potential scenarios. A bearish continuation seems the more likely scenario long-term, given the fundamental picture. I'd give this a 60 to 70% probability. This would be reinforced if price fails to break 0.5850 and breaks the hourly uptrend line, or if this week's US jobs data comes in very strong, putting Fed rate cuts further on the back burner. The target would be new lows below 0.5750. A bullish corrective scenario has a lower probability, perhaps 30 to 40%. This would be reinforced if the US shutdown drags on, causing more economic damage and significant USD weakness, or if the NFP report on Friday is a massive miss to the downside. In this case, a break above 0.5850 could see the price rally towards the next major resistance around 0.5950. So, keep a close eye on the 0.5850 level, the hourly trend line, and the upcoming US jobs data this week. Those will be the keys to determining the next major move for NZDUSD. That's our analysis for today. Remember, this is not financial advice. Always conduct your own research and analysis before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next one.